Welcome to Breaking News to Trading Moves.
Glad to be here.
So let's just get right into it for you. Imagine a wildly popular, exclusive restaurant, right? And they take $50 billion in reservations for tonight.
That is a lot of food.
It really is. And they just told their investors they successfully raised their menu prices by a massive margin. But then, almost in the exact same breath, they warn they might actually only serve a fraction of those meals before closing time.
Right. The kitchen gets backed up.
Exactly. And today, Supermicro Computer trading under the ticker SMCI, they reported exactly that kind of dynamic. They booked $60 billion in new orders during their fiscal fourth quarter.
Pushing their backlog to an absolute record level.
Yeah, exactly. But the financial metrics underneath that raw headline, well, they paint a highly complex picture of supply chain reality. So we are going to go through the numbers, identify the clear winners in the market, the potential losers, and then lay out the trading setup for you.
Which is crucial because Supermicro sits directly at the center of the artificial intelligence hardware build-out.
Right. I mean, they aren't just selling basic computers here.
No, not at all. When an enterprise wants to build a data center capable of training large language models, they cannot just buy raw processors and, plug them into a wall.
Yeah, it requires a comprehensively engineered system.
Exactly. And Supermicro builds those systems. They take the raw silicon and integrate the networking components, the specialized power management hardware,
And the liquid cooling.
Right. The liquid cooling solutions directly into the server racks. So they are the architects turning individual components into functional, high-performance computing clusters.
Okay, so looking at the raw financial metrics from the report, it requires us to really look past that $60 billion headline.
Definitely.
The margin forecast is where the data gets compelling. Gross margins are now expected to hit 15 to 17%.
Wow.
Yeah, which is well above their previous forecast of just 8.2 to 8.4%.
Yet it's a massive jump.
It is. But the contrasting metric is the near-term throughput. Revenue is expected near the lower end of their $11 billion to $12.5 billion guidance range.
So back to your restaurant analogy.
Right, exactly. They have the demand, they have the pricing power to charge more per plate. But the kitchen's immediate ability to push food out the door is constrained.
And the market is attempting to price in that specific contrast. I mean, an order total of that magnitude confirms AI infrastructure demand remains robust. Cloud providers are spending aggressively.
Right. But a backlog is just a promise on a spreadsheet, isn't it?
Exactly. Investors require hard evidence that this massive demand will actually convert into physical deliveries, realized revenue, and free cash flow. Delivering an AI server rack requires coordinating thousands of distinct components.
Right, so if one thing goes wrong.
Yeah, if a single specialized cable or a specific valve for the liquid cooling system is delayed by a supplier, the entire multi-million-dollar rack sits on the factory floor.
Unable to be shipped or billed.
Exactly. It just becomes an inventory bottleneck. They are paying for the components, tying up their own cash, but they cannot collect the final payment from the customer until the finished product is plugged in and running at the data center.
That makes total sense. So because that $60 billion order book confirms aggressive spending, we need to trace where those dollars flow next. Let's look at the winners.
Okay, let's hear it.
The direct beneficiaries in the hardware space include AI server platforms like Dell Technologies, ticker DELLL, and Hewlett Packard Enterprise, ticker HPE.
Right.
And it also includes the GPU suppliers like NVIDIA, ticker NVDA, and Advanced Micro Devices, ticker AMD.
Yep, the core components.
Now, Supermicro is the clearest winner here because that jump in gross margins directly addresses profitability fears. But I have to push back a little here on Dell and Hewlett Packard Enterprise.
Okay, how so?
Well, if Supermicro is capturing $60 billion in orders and establishing dominance in liquid cooling integration, Dell and HPE kind of seem like they are just picking up the leftover scraps. How are they winners?
Well, consider the sheer scale of the total addressable market. Supermicro holds a leadership position in this specific high-performance, liquid-cooled segment. But the overall demand for computing capacity vastly exceeds what any single manufacturer can physically produce.
Well, we're integrate.
Right. Dell and HPE still benefit from the baseline hardware demand because enterprise customers need systems deployed now.
So they just go to whoever has capacity.
Exactly. They will go to secondary vendors if the primary vendor has a months-long wait list. Buyers want to diversify their hardware supply chains to avoid being entirely dependent on a single company's manufacturing timeline.
Okay, so they capture the overflow. But the ceiling on their upside feels substantially lower, right?
Yeah.
Especially if they are competing on standard configurations rather than the specialized high-margin liquid cooling setups.
That is fair. Their upside might be smaller. But the components inside all of these servers lead us directly to NVIDIA and advanced micro devices.
Because Supermicro doesn't fabricate the actual silicon brains of the operation.
Right, they purchase them. So a backlog of that size for the integrator translates immediately into demand expectations for those advanced processors. NVIDIA has the strongest read-through since its GPUs power the vast majority of these systems.
And advanced micro devices.
AMD serves a vital alternative role for the ecosystem. Customers look at a massive order book and recognize supply chain realities. They need alternative accelerators to keep their projects moving forward. AMD provides a competitive option for customers needing more supply right now.
Got it. Okay, so hardware of this caliber demands an entirely new class of support infrastructure. It's like upgrading a house, right?
What do you mean?
Well, before you can put in a massive high-end home theater system, the GPUs, you have to upgrade the house's electrical panel and the air conditioning.
Oh, that is a perfect analogy.
Right. So that leads us directly to the infrastructure support winners. Arista Networks, ticker ANET, Broadcom, ticker AVGO, Vertiv, ticker VRT, and Eaton, ticker ETEN.
And retail investors routinely overlook this segment. Yeah, yet it dictates whether the expensive silicon can actually function. Arista Networks and Broadcom, they capitalize on the connectivity and fast networking.
Because the networking has to be incredibly fast.
Exactly. In an AI cluster, traffic flows east-west. Training an AI model requires distributing a massive data set across tens of thousands of GPUs simultaneously. If the networking switches or the optical transceivers are slow,
You just have $100,000 chips sitting idle.
exactly, waiting for data packets to arrive. Arista and Broadcom design the specialized hardware that prevents those bottlenecks.
So they are basically the nervous system. But then the physical environment itself is where things get tricky. Vertiv and Eaton capture the electrical and thermal management needs.
Right, the power and cooling. The physical reality of packing thousands of processors into a dense server rack creates thermal dynamics that traditional data centers were just never built to handle.
Because traditional servers just rely on fans, right?
Right, forced air cooling. But air is an insulator by nature. It is terribly inefficient at transferring heat away from high-density silicon.
It just can't keep up.
No, AI server racks generate heat so intensely that air cooling is no longer physically sufficient. Liquid has a far greater specific heat capacity than air. Vertiv specializes in designing these advanced thermal management systems.
Like the direct-to-chip liquid cooling plates.
Exactly, the ones Supermicro integrates. And then Eaton handles the power delivery. An AI data center draws electricity comparable to a small city.
Wow.
You need industrial-scale transformers and uninterruptible power supplies to ensure clean electricity flows to the racks. Eaton provides that reinforced electrical infrastructure.
Okay, so high demand and heavy spending are clearly great for the equipment sellers. But those exact same dynamics present major challenges for the buyers and the rivals. Let's move to the losers.
Okay.
First up, the server rivals. And I'm bringing up Dell and HPE once more.
I see where you're going with this.
Yeah, because we just discussed them as winners of the overflow demand. The contradiction here is glaring. How do companies benefiting from overall sector growth suddenly become relative losers?
Because market valuation relies entirely on relative positioning, Dell and HPE will physically sell more servers. But if customers start consistently preferring Supermicro speed and custom liquid-cooled configurations...
Oh, then Dell and HPE face structural market share erosion.
Exactly. Strong sector demand isn't enough if you are losing your actual market share to a rival.
That makes sense. Okay, let's look at the actual buyers funding this, the hyperscalers. Microsoft, ticker MSFT. Amazon, ticker AMZN, Alphabet, ticker GOOGL, and Meta Platforms, ticker META.
The richest companies on Earth.
Right. So how can buying exactly what they need make them losers? I mean, they are cash-rich technology giants.
Well, the mechanics involve free cash flow. A $60 billion backlog at a single supplier means these cloud giants are committing staggering amounts of capital toward physical infrastructure.
And that hits the balance sheet immediately.
Yes, as a massive cash outflow. It pressures their free cash flow. When a company like Meta or Alphabet buys $10 billion of servers, the hardware begins depreciating the moment it is plugged in.
Ah, the capital expenditure cliff.
Exactly. They are absorbing massive depreciation costs today for AI revenue they hope to generate years down the line.
Which depresses their earnings.
Right. And if their AI revenue does not grow quickly enough to match the spending, investors will demand clearer returns on the capital.
Causing their stock to struggle.
Exactly.
Wow. Okay, so if the cash-rich tech giants are feeling the pressure of these costs, the smaller players face an even steeper climb. Which brings us to the financing-sensitive operators. CoreWeave, ticker CRWV, Nebius Group, ticker NBIS, and IREN, ticker IREN.
The independent operators.
Right. But I have to ask, why wouldn't strong AI demand automatically benefit these smaller infrastructure operators? They literally sell access to AI compute.
Because of the heavy upfront spending required, building an independent AI data center requires extreme upfront capital for chips, facilities, power, and cooling.
And they don't have the internal cash reserves of an Amazon or Microsoft.
Exactly. So when equipment costs escalate, these smaller operators must routinely access the capital markets. They have to issue new equity, which dilutes shareholders, or they must take on heavy debt.
Oh, and raising debt right now comes with severe carrying costs.
Right. And debt comes with strict covenants. If a facility isn't generating revenue because they're waiting on a delayed shipment,
They risk tripping those covenants.
exactly. The need for new financing or any delivery delays can severely hurt these operators. Higher equipment costs act as a financial vice grip on them.
A brand new facility sitting completely empty while the interest payments continue to accrue every single day.
It's a perilous situation.
Okay, so having laid out the players, the discussion naturally moves to the mechanical setups for traders navigating this news. Lay out the exact scenarios traders are watching here.
Sure, let's start with the bullish setup. The strongest setup occurs if SMCI holds its post-announcement gap on high volume.
So it opens higher and absorbed the initial profit taking.
Right. If it holds, that signals strong conviction. It tells us the market views the margin expansion as the true metric. And if that happens, momentum could spread directly into NVDA, AMD, ANET, and VRT as traders position for continued demand.
Okay, and the bearish setup.
The setup turns bearish if SMCI gives back the gap. If the stock fades, market attention actively pivots back to the low-end revenue guidance.
I start worrying about the order quality.
Exactly, or the financing requirements across the sector. Traders will remember that some orders may still be delayed or canceled.
Right, a backlog isn't always bound by ironclad contracts.
No, it isn't. And you have to remember, the figures remain preliminary until the full results are released on August 11th. Traders are watching the tape to see which narrative commands the capital flow.
That is incredibly clear. So we've gone through the raw numbers, the winners, the losers, and the setups. Before we wrap up, leave the listener with a final thought to consider as they process all of this.
Well, the headlines show that demand remains powerful. The hardware is being ordered. But the true test in the next phase of this trade will be determined by execution, margins, and cash flow, rather than order headlines alone. Because when all of these advanced liquid-cooled servers are finally delivered and plugged in, does the local physical power grid actually have enough electricity generation to turn them on?
Oh, wow.
Yeah, that power grid bottleneck is the next constraint the market has completely failed to price in.
That is definitely something to watch. This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.